I want to tell you about a Tuesday morning in March. Nothing dramatic happened that day. No celebration. No confetti. No moment where someone handed me a plaque or rang a bell or told me I'd crossed a line that mattered. I just opened my investment app before coffee. Looked at the number. And something felt different. Not because of what I could buy. Not because of what I could spend. Because of what I could see. For the first time in years of building, I could look at that number and feel the math working for me instead of against me. Like the current had shifted direction. Like I'd been paddling upstream for so long that I'd forgotten what it felt like when the river started carrying you. The number was $250,000. And I've talked to enough people since then to know that I'm not the only one who felt it at exactly that threshold. Not at $100,000. Not at $500,000. Somewhere right around $250,000, something shifts. In the math. In the psychology. In the way the financial system itself begins to treat you differently. Today we're going to talk about what actually changes at that number. Not the fantasy version. The real version. The mathematical reality, the psychological shift, the practical doors that open, and the entirely new set of problems nobody warned you about. My name is Money Sketcher, and I sketch out the financial patterns most people can't see until they're already inside them. If you're building toward a number and wondering what it actually feels like when you get there, subscribe right now. Because today we're naming the thing most people feel but nobody explains. Quick note, I'm not a financial advisor and this isn't financial advice. This is pattern recognition and math. The kind that changes how you see your own trajectory once you understand it. Let's sketch it out. Before we get into what changes, I need to answer the obvious question. Why $250,000? Why not $100,000, which feels like a major psychological milestone? Why not $500,000, which feels like real wealth? The answer is math. Specifically, one piece of math that most people have heard but very few have actually felt in their own account. Compound interest. At $10,000 invested, a 10% annual return gives you $1,000. Meaningful. Encouraging. But still smaller than what most people earn in a week or two of work. The compounding is theoretical at that scale. You know it's happening but you can't feel it. At $100,000, a 10% return gives you $10,000 in a single year. That's more tangible. That's a month or two of take-home pay for most people. The compounding is becoming real. At $250,000, a 10% return gives you $25,000 in a single year. For most Americans, that's 3 to 5 months of salary. Generated without a single additional hour of work. Without a promotion. Without a side hustle. Without showing up anywhere. That is the threshold where compound interest stops being a concept you understand and becomes a force you can actually feel. Where the money starts doing work that rivals your own labor in scale. Where the second income stream, the one that doesn't require your time, becomes impossible to ignore. There's also a mathematical acceleration that happens at $250,000 that doesn't exist at lower numbers. Because of the base effect of compounding, the jump from $250,000 to $500,000 at historical market returns takes roughly half the time it took to go from $0 to $250,000. And the jump from $500,000 to $1 million takes roughly half the time again. You've spent years climbing the first half of the mountain. The second half has a different grade. At $50,000 in invested assets growing at 7% annually, your portfolio generates approximately $3,500 per year in growth. About $292 a month. Encouraging. Meaningful. But comparable to a modest side gig. At $100,000, your portfolio generates approximately $7,000 per year. About $583 a month. Starting to feel real. At $250,000, your portfolio generates approximately $17,500 per year in growth. About $1,458 a month. That is, for a significant percentage of the American population, more than their monthly car payment, their health insurance premium, and their utilities combined. Growing automatically. Every month. Whether you show up or not. But here's the number that actually changes behavior. The 4% rule, the standard framework for sustainable retirement withdrawals, says you can withdraw 4% of your portfolio annually without depleting it over a 30-year retirement. At $250,000, that sustainable withdrawal is $10,000 per year. Or $833 a month. In perpetuity. That number starts covering real things. It covers a car payment. A modest rent contribution. A substantial portion of a family's grocery bill. You haven't retired. But you've built a permanent, self-sustaining income stream that covers a real slice of your actual cost of living. And it will be there, theoretically forever, regardless of whether you ever work another day. That is a fundamentally different relationship with money than anything that exists below that threshold. The mathematical shift is significant. But in my experience and in the experience of people I've talked to who've crossed this line, the psychological shift is more immediate and more profound. Here's what actually happens in your head at $250,000. The fear changes character. Below $250,000, financial fear is primarily about loss of what you have. The emergency that wipes out your savings. The job loss that sends you backward. The market crash that takes 3 years of progress and cuts it in half. The fear is about subtraction. About going back to zero. At $250,000, that fear doesn't disappear. But it changes shape. Because the math tells you something different now. A 50% market crash, one of the worst events in modern financial history, takes your $250,000 to $125,000. Which is devastating on paper. But $125,000 is still a significant financial cushion. You haven't gone to zero. You haven't lost your shelter. You haven't lost your ability to cover emergencies. The floor has risen. And that risen floor changes risk tolerance in ways that are both mathematical and deeply emotional. The second psychological shift is about time. Below $250,000, most people's relationship with their portfolio is anxious and frequent. They check it when the market moves. They feel sick when it drops. They feel briefly euphoric when it rises. The portfolio feels fragile. Temporary. Like it could go away. At $250,000, something changes in that relationship. Because the number is now large enough that even a bad year leaves you with something substantial. The psychological weight of the portfolio shifts from, "this could disappear," to, "this is a permanent feature of my life." And that permanence, even when it's not technically guaranteed, changes how you carry yourself. How you make decisions. What you're willing to walk away from. I've seen this described by researchers as the threshold of financial dignity. The point at which a person's financial situation stops being primarily a source of anxiety and starts being a source of baseline security. Not comfort necessarily. Not luxury. Security. The quiet knowledge that a certain category of disasters simply cannot reach you anymore. This is the part that nobody talks about because it's uncomfortable. But it's real and it's important, and pretending it doesn't exist doesn't help anyone. The financial system treats people differently at $250,000. Not because people change. Because the system is designed to respond to capital concentration. Here's what practically opens at that threshold. Private banking relationships. Most major financial institutions define the lower bound of their private banking or wealth management tier at somewhere between $250,000 and $500,000 in investable assets. Below that threshold you are a retail client. You call a phone bank. You get a different level of service. Above that threshold, proactive service, dedicated relationships, and in some cases access to investment vehicles not available to retail clients begin to materialize. Access to private credit and lending terms. At $250,000, your relationship with debt changes. Not because you necessarily want more debt, but because the terms available to you improve substantially. Banks and credit unions offer meaningfully better mortgage rates, personal credit lines, and business lending terms to individuals with demonstrated asset bases above this threshold. The interest rate differential on a 30-year mortgage between someone with $50,000 in assets and someone with $250,000 in assets can be substantial enough to represent tens of thousands of dollars over the life of the loan. Tax strategy complexity worth pursuing. Below $250,000, basic tax optimization handles most of what's available. Max the 401k. Fund the Roth. Maybe open an HSA. The advanced strategies exist, but the dollar impact doesn't justify the complexity. At $250,000, tax loss harvesting at scale becomes meaningful. Backdoor Roth conversions become relevant. Asset location strategy across taxable and tax-advantaged accounts starts generating real dollar impact. The tax planning conversation moves from filing returns to actually structuring your financial life for minimum lifetime tax burden. And the difference between someone who does this and someone who doesn't compounds just like everything else. The people who understand tax strategy at this level don't just save money this year. They save money every year. And those savings compound. Here's the part most financial content skips entirely. Because it's less inspiring than the upside. But if you're building toward $250,000, you need to know this too. Hitting $250,000 creates a specific set of new problems. Not catastrophic problems. Not problems you trade for the old ones. But real ones that will catch you off guard if you're not expecting them. Problem 1. Decision paralysis at scale. Below $250,000, your investment decisions are relatively simple. Keep adding to your index fund. Don't sell during crashes. Stay the course. The strategy writes itself. At $250,000, the number of legitimate strategic decisions expands dramatically. Asset allocation across account types. Tax loss harvesting timing. Rebalancing strategy. Whether to pay down mortgage debt or invest the difference. Roth conversion opportunities in low-income years. The complexity isn't imposed by anyone. It emerges organically from the options that become available at that scale. And if you're not prepared for it, the response to this complexity is often inaction. Which has its own costs. Problem 2, the lifestyle pressure intensifies. At $250,000, the gap between what you have and what the people around you can see you have starts to widen visibly. And social systems respond to visible wealth signals. The expectations from family can shift. The asks get larger. The assumptions about what you can afford change. And the psychological pressure to let your lifestyle catch up to your net worth intensifies in ways that can genuinely threaten the financial foundation you've built. The wealthiest people I've observed at this threshold are the ones who figured out that the goal isn't to look like what $250,000 feels like. The goal is to turn $250,000 into $500,000. Which requires not spending it on the things that $250,000 is supposed to unlock. Problem 3, the comparison class shifts. Below $250,000, your financial reference group is mostly people who are also building. The conversations are about strategies and savings rates and index funds. The energy is collaborative. At $250,000, you start to encounter a different class of people, often through professional networks or certain social contexts, for whom $250,000 is a starting point rather than an achievement. And the social comparison system, which we know from behavioral research operates almost automatically in human beings, recalibrates. Suddenly the benchmark is different. And what felt like significant progress can start to feel inadequate in ways that have nothing to do with your actual financial situation and everything to do with your reference group. This is not a reason to hide your success or avoid ambitious people. It's a reason to understand that the psychological recalibration happens and to choose how you respond to it deliberately rather than automatically. Here's the honest mathematical picture of what $250,000 makes possible if you don't touch it. At historical market returns of 7% annually after inflation, $250,000 becomes $500,000 in approximately 10 years without adding another dollar. $250,000 becomes $1 million in approximately 20 years without adding another dollar. $250,000 becomes $2 million in approximately 30 years without adding another dollar. If you continue contributing even modestly, say $1,000 a month going forward, those timelines compress significantly. The $1 million threshold arrives in roughly 14 years instead of 20. The $2 million threshold arrives in roughly 22 years instead of 30. You have built the machine. The machine is running. Your primary job now is to not break it. That sounds simple. It is not simple. Because the things most likely to break the machine at this stage are not market crashes or economic recessions. They are the lifestyle decisions that seem affordable now that you have $250,000. The house upgrade. The car upgrade. The private school tuition. The business venture that consumes capital without generating returns. None of these are inherently wrong. But each one is a withdrawal from the machine. And withdrawals from a compounding machine at the $250,000 threshold have consequences that stretch 30 years into the future. The person who reaches $250,000 and immediately upgrades their lifestyle to reflect it can find themselves building toward $250,000 again 5 years later. The person who reaches $250,000 and treats it as the starting point rather than the arrival finds themselves at $500,000 faster than they built the first $250,000. That asymmetry is the most important thing to understand about this threshold. Here's what I actually want you to take from this. $250,000 is not the finish line. It was never the finish line. And anyone who told you it was selling you a feeling rather than a framework. But it is the threshold where the math changes enough, where the psychological landscape shifts enough, where the system responds differently enough, that it deserves to be understood on its own terms. The people who navigate this threshold well are the ones who understood what was actually changing before they arrived. Who didn't mistake the milestone for the destination. Who used the changed math, the risen floor, the new strategic options not to relax but to accelerate. And the people who navigate it poorly are the ones who felt the shift and immediately spent it. Who let the reference class recalibration go unchecked. Who made the lifestyle decisions that seemed reasonable given the number and found themselves wondering a few years later why the number wasn't growing the way they expected. The threshold is real. The change is real. What you do with it is entirely up to you. If you're somewhere below $250,000 right now and building, keep going. The math gets better. The current shifts. The river starts carrying you. It's worth the paddle. If this landed where it needed to land, share it with someone who's in the middle of the build and needs to know what's waiting on the other side. I'm Money Sketcher. I'll see you in the next one.